So if you think about different types of investors, imagine you've got four investors sitting at a table, and on the left side of the table, you've got investors that I would say are risk averse investors. For right now, let's forget about what their ages are, but let's just say that side of the table is really a more risk averse investor. And on the right side of the table, you've got two investors that are willing to accept risk along the way. And the big question is, who is going to end up generating greater wealth at the end of the rainbow? So why don't we break that down a little further? Let's talk about the risk averse investors. Two major types. There's your typical public equities investor who are risk averse. And then, Ty, as you know, we have real estate investors that may also be a little more risk averse. So what does that public markets investor do to help protect some of the downside? Well, annuities are a great example. There's a reason why annuity sales spike when we see volatility like we've had today, especially if there's been a big downturn. Because one of the benefits, I'm not downplaying annuities, they can be a good strategy for the right investor. One of the benefits of annuities is they have a number of different provisions. There's hundreds of provisions. One of those is you can lock in a high water. So if you do see the markets go up and down and ultimately it goes down, it is going to set the value at a high watermark. Typically, that's done on an annual basis for purposes of determining what your income is going to look like ultimately when you retire. So it's a very, I'll say, popular strategy, especially for pre-retirees who are concerned more about volatility and they want to lock in, let's say, this high watermark provision for purposes of determining their overall retirement income. The other thing is that those products sometimes carry living benefits, they carry death benefits, and they protect the potential of having distributions possibly go down once you start taking those again, typically at retirement. So that's the benefit. What are the drawbacks? Well, you don't get that for free. You know, an insurance company isn't going to give you that benefit out of the goodness of their heart. They're going to charge for it. So you are paying for the insurance. Typically, those fees can be 2% or even greater. And what you're essentially doing is shifting the risk of a market downturn from you to the provider, the insurance company, but you are going to pay a price for that. Let's also talk about the left side of the table, and that would be the real estate investor. What about
Well,
a real estate investor?
before you go to the left side of the table,
Yep.
what, so explain to our audience exactly in third grade English, because this is something, and I've got a master's in accounting, and I don't necessarily understand the high watermark setup and what that is. So what's a high watermark step up, and
Yep.
what exactly does it promise to investors? And then also, but what does it cost an investor over time?
Yeah, really good question. So let's just use a dollar figure. Let's say you invested $100
Okay.
in a variable annuity contract, which had a high water provision. And over the course of 5 years, let's say that the value of that, it's a variable annuity, so it invests in public equity markets. Let's say the value of that rose to $120 and then it went down because of volatility to $80. Well, when you retire at the end of, let's say, 5 years, it could be longer than that, they will set your benefits base not at the $80 that it's worth today, but at the $120 that it actually rose and grew to. So that's, you think about water kind of going up and down, they're basically going to lock in your benefits base at that high water mark. And typically that's pegged on an annual basis. So it's not done every day that the market's open. They'll look at it and say, okay, on this date of the year, what was the valuation? That locks in that high watermark for that specific year, and they do it again the next year and the next year, and then at some point you retire, and that's going to lock in your base, and then the distributions that you're going to get paid on it are going to be based on that benefits base of, in my example, $120, not the $80.
And so obviously that comes with a cost, because you're getting the benefit of the peak at every given year. So what does that cost over a period of time?
Yeah, so that's going to vary based on the number of features that you want to build into the annuity provision. Think of buying insurance. If you've recently renewed your homeowners or your car insurance, the more features you want, the more it's going to cost. And
And this
so
is going to come in the form of fees.
It's going to come in the form of fees. That's exactly right. And it's typically a percentage of invested assets. So while you have $100 in my example invested, to get kind of a general benefits base provision where they do lock in that high watermark, they're going to charge you somewhere around 2% just for that. So think of it this way: if your
You're
earnings,
gonna be running on 7 or 8% in total fees on your invested $100 in your
uh,
example, by the time you're all said and done with that annuity, I'm sure.
potentially, yes, yes. The more features and the more, I'll say, advantages that you want to protect you on the downside, the more fees you're going to be paying. Absolutely.
So then you brought up, on the other side of the table, or the more risk averse side of the table, or real estate. How do you alleviate some of the risk? And we've done this in the past. So I'm curious on your thoughts on this strategy, because we've used this strategy that I think you're going to talk about in the past, and it comes with pros and cons as well. And before we go into that, I'm going to kind of give maybe an analogy a little bit, because oftentimes people, the majority of people are risk averse and not willing to necessarily ride the risks. Oftentimes it's the entrepreneurs, it's the really motivated that are willing to take some risk. And what you end up getting, it's like the Wayne Gretzky approach. If you're going to be risk averse and not take the shot, then you're guaranteed to miss the shot. But the person who takes 100 shots is going to make a shot. And so, you know, you hear all the time that the best offense is a good defense. That's for somebody that doesn't want to win. You still have to play offense. And if you take the analogy of you put a metal ball, you take two metal balls and you put one of them on a track that has a steady 5% decline on the track. It's just a flat 5% decline on the track. And you take another ball that has an equally as long track in linear distance, but that track has an up and down. It has peaks and valleys, highs and lows along the way. And the start and the end have the same overall decline that the one that has a steady 5% decline has. And you let both balls go at the same time. The one with the steady decline for the first half or so is going to be out in the lead. And you're going to have this other one that drops down and then up, and then down and then up, and then down and then up. And it's going to start picking up momentum. And it's the one that has those ups and downs along the way that ends up winning in the long run. And what I get by that is, what I mean by that is, you've got to be a little bit risk averse. You've got to take some risk in order to experience the ultimate financial goals that you want to experience. And if you take no risk, well, you're giving up first inflation, oftentimes tax inefficiencies, and fees that are going to come in the form of your financial advisor or the mutual funds that you invest in. And net, maybe you grow your portfolio by 3 or 4% at best over a 30-year period.